All right, welcome everyone to what is our first CPD webinar for 2023. And it is my top 5 SMSF strategies for the year ahead. It's all about giving you some insight into topics that I think will be shaping the SMSF sector over the 12 months ahead. And a lot of this, of course, relates to activities that we've seen over the past year or so, and potentially what we can see ahead with changes from this current year or even into the new financial year. So really giving you some context and, as I said, some insight into the areas that I see are going to continue to shape this year. Now, of course, there will be a whole range of other things. We can think of the quality of advice review. We know that the NALI consultation is currently out at the moment. These are a number of topics that, of course, are going to play a very significant role, but very much so, today's event is about the strategies and the things, the important things that you could be looking at with your clients right now. So without further ado, let's get things underway. But of course, the context in which we provide this session for you today is that we are doing this in a way in which you need to, of course, understand the rules as they stand and the way in which we are applying that context for you as well. So let's go through and touch on what we are going to be exploring. And it's pretty simple, of course, because I'm going to take you through my top 5 SMSF strategies. So I'm going to give you some technical context into the topic, and where relevant, I'm going to give you a number of examples to help you understand many of the issues that we go through, the tips and traps, and just those little things that you'll need to be aware of. Part of today is, of course, we want to not only share that with you, but give you some ideas around some of our CPD that we are looking to do in this 2023 financial year. And finally, we'll give you some key takeaways from that as well. Now, as I said earlier on, I will ensure that you get a copy of today's slides as part of the follow-up. And if you do have any questions as you go along, please feel free to add those into either the Q&A or the chat area. I will endeavor to get to them. If I get a chance, I'll try to answer them as we go along. Otherwise, I will hang around and make sure that I answer them. And if we have a huge amount, what I would typically do is record a Q&A podcast, which I will also make available to share with you after today's session. So let's get stuck into things. And the first thing here is really around the fact that our contribution planning is potentially going to be on the move again. And on the move from the 1st of July 2023, where we are now likely to see indexation rise. So our transfer balance cap, as it currently stands at $1.7 million, will now increase to $1.9 million. So what we have seen is the recent quarterly CPI figure release for December 2022. And what that indexation has confirmed, as you can see in the calculation on the screen here, is that that amount, by virtue of the CPI figure for that December period, has meant that we will see an increase from 1.7 to $1.9 million from the 1st of July 2023. Now, that, of course, has a number of opportunities, which we'll talk about, but also is quite clearly going to be adding to the complexities of managing your clients' contributions, the way in which we operate bring forward rules, the way in which we have credits and debits applied against a member's transfer balance cap. And it's that personal cap that is now very much in play, in addition to the general transfer balance cap, that is again going to play a pretty significant role, because the indexation may or may not occur with a personal transfer balance cap, subject to the available cap space that that person has at any particular point in time. So as we know, the total superannuation balance here, for the purposes of making contributions, is actually linked to the general cap when we think about the way in which contributions might be made, either in its initial year or potentially in year 2 or year 3. So the anticipated changes that we're going to see here is this threshold of 1.7 million going up to 1.9 million. So where we're at that threshold or higher, you would not be eligible to make contributions either in that initial year or subsequent years. And then we need to go back and apply that reduction off in each particular year to work out whether we have a 1 year, 2 year, or 3 year bring forward period where we have those various thresholds that you can see on the screen. So that current $1.48 million moves to $1.68 million. So let's also look at and understand whether we're going to see any further changes here, because what we saw in 2021 was not only the adjustment to the general transfer balance cap, which of course is linked to CPI and increases in $100,000 increments, but we also saw the concessional contribution cap rise. Now, will we see this happen again? The short answer is we are unlikely to see it. And the reason being is that this is not linked to inflation, but rather it is linked to wages. So therefore, the fact that, yes, we've been seeing some level of wages growth, the reality is we'd need to see annual wages growth of about 5.3% or more. And the reality is we arguably won't see that, which means that our caps that currently exist at 27.5 and 110 and then $330,000 will stay the same. And this is where this complexity, I guess, of managing all these different thresholds becomes quite unique and therefore critically important in the advice and management that you're providing to your SMSF clients. So what does this mean? As I said, so there's no impact on amounts that have been previously triggered under the bring forward because the caps here are likely to stay the same. So if a member has triggered a $330,000 bring forward rule in that prior year or even in the current year, then we don't need to contemplate anything further around whether there's any uplift or any of those sorts of things, okay? So they're not going to miss out on any uplift because of this change here. But what is going to be important is that the TSB uplift will actually help to utilize NCCs within that bring forward period, because we may have circumstances where a member has triggered that bring forward period and is eligible to make non-concessional contributions in year 1 and then obviously year 2 and maybe year 3. That total superannuation balance indexation here does allow or provide greater scope to qualify to make those contributions. Okay, so the fact that we are seeing that cap increase from 1.7 to $1.9 million may offer the opportunity for that individual to get that $330,000 or $220,000 into the fund, subject to whether they are in maybe a 2-year or 3-year. So let's take a look at an example and show you here how this would work. So we've got Mary. She has a total superannuation balance of $1.45 million. At the 30th of June, 2021. So she was under the $1.48 million that would allow her to bring forward her non-concessional contributions in the current landscape. So she makes an NCC of $180,000 in the 2021-2022 financial year and therefore triggered a 3-year bring forward period. At 30 June 2022, her TSB had increased significantly to such an extent that she is above the general transfer balance cap, which means for the year that we are in right now, she would be ineligible to make any further non-concessional contributions into the fund because the difference, the opportunity to make contributions is the lower of 0 if she had breached the general transfer balance cap of $1.7 million, or the difference between the available bring forward that she had of $330,000 less the amount she made contributed in year 1. So this is where the advantage of this indexation may come in to help Mary in this circumstance. So when we get to the 1st of July 2023, due to that indexation, we would see that general cap having increased to $1.9 million. Now, Mary's balance has continued to grow, contributions and investment performance. So her balance has gone from 1.76 million now to 1.83 million. So if we didn't see any indexation, or even if we'd only seen $100,000 of indexation, she would be ineligible again in year 3. But in this circumstance, because the cap has increased to 1.9, she would be able to now make that remaining $150,000, because again, it is the lower of zero if she was above that $1.9 million, or the difference between what was initially made in year 1 and year 2 as she qualified, less the contribution cap space that she has available to her. So in essence, she had a $330,000 bring forward that she could make into the fund. She'd used $180,000 in the first year. She was ineligible in the second year, which means she can now contribute the $150,000 in that final year. Okay, so really good opportunity. Now, quite clearly here, the thing that we need to be conscious of is the fact that whilst the indexation has normally taken its course here, and historically, since these introductions of the superannuation reforms from the 1st of July 2017, we've seen that continue on from 1.6 to 1.7. We do know quite clearly that the Labor government is going to look at superannuation generally, and in particular the areas of adequacy, and therefore whether we may or may not see some sort of freeze around indexation. So this is, I guess, the great unknown as it sits right now. But all things being equal, and we play with the rules that and the cards that in essence dealt to us at this point in time, that cap in essence has now been confirmed to move from $1.7 million to 1.9. That is the way the law works, and therefore we would need an amendment to the law to allow for any sort of freeze or reduction around that particular figure. So it is critical here to remember how the general cap indexation applies and how it applies differently to personal cap indexation. Because yes, we're seeing it go from 1.7 to 1.9, but if someone started a income stream initially with $1.6 million and they used that entire cap, then they got no further cap indexation when it moved to 1.7, and neither will they when it moves to $1.9 million. And even where they may have gone through some commutation strategies, where they might be taking some lump sums out, in particular in this reduced minimum pension environment at the moment, the fact that they at one point in time had used up 100% of their balance means that they get no benefit of indexation. So we're not simply looking at the value at the particular point in time when the indexation occurs. We're looking for the smallest available cap space that a person has at any point in time since that transfer balance account was established for that individual. So if we've used it in its entirety, then in essence, there is no indexation that will apply. And what that means is for some of your clients that may be looking to commence retirement phase income streams, you do have this potential to defer the benefit of doing so that they might pick up the entire extra $200,000 rather than potentially starting now and therefore getting a proportionate level of indexation or an amount that is much less if they use that entire $1.7 million right now. So think about this as you're working through. Obviously, tax exemption on the flip side is an important consideration in that, but we do need to understand that that benefit doesn't ordinarily carry through once we have a credit applied against a person's transfer balance account. Now, the other thing, we might be looking at these strategies with our clients, and we might have the opportunity to look to wait until we have that amount credited, say from the 1st of July, if that indexation goes through as planned, but there may be circumstances where we can't. Okay, so we may ultimately have someone that is drawing a transition to retirement income stream, and by virtue of them turning age 65, that in itself becomes an auto credit event for transfer balance cap purposes. So therefore, in that instance, we need to ensure that that credit happens at the point in time that they turn 65, which therefore means we might not pick up that benefit that I just spoke about earlier. So these are all things that you just got to be conscious of as we work through this general cap indexation. And the other one, of course, is our reversionary pensions. We may have clients that are, I guess, the beneficiary of a reversionary in respect to the death of that primary individual. But what we have is a death benefit, and that credit that is to apply, the value has been determined at the date of death, or what is known as the starting day, but we have a 12-month deferral until that credit is applied. So therefore, again, we don't get the benefit of trying to manipulate that time frame. In essence, if we go beyond that 1 July 2023, where that credit will apply, then there would be, of course, the scope for that indexation if that individual hasn't, if that reversionary beneficiary hasn't actually had any credits applied to their account before. So in essence, they're starting that for the first time. But again, there may be some level of proportional indexation if, again, that credit doesn't apply until after the 1st of July 2023. So lots in there to be thinking about. But again, this concept of indexation is really going to kick in, and therefore you need to start thinking about, well, what clients are going to be impacted by these changes? What clients are making contributions? What clients are looking to be starting pensions out of the self-managed super funds? What clients are going to be having credits applied within the next 6 months or more? And therefore, what impact does that have with their transition to retirement income streams and the notice of when they may be retiring? Because remember, with a transition to retirement income stream, they might look to be retiring now and they might apply the retirement condition, but the credit doesn't apply until there's notice that's been served. So you could potentially delay in that instance that notice to serve on the trustees, so you defer the credit itself. It's only the age 65 where that auto credit event would actually apply. So again, lots of things to be thinking about here with that indexation, with that little asterisk at the end, where the government may or may not look to change anything. And I think when we think about that potential impact is if you might be deferring, and then the government is going to be looking at any potential change here, which I would argue is more unlikely than likely if I'm a betting man. But the reality is they're not going to do anything retrospectively. So of course, you've still got your $1.7 million to play with. So if something came out that there's going to be a freeze, you're going to wait until the 1st of July. Well, then what you could clearly do is you could go and start that pension immediately and therefore enable the credit to be applied from that particular point in time whenever that's actually commenced. So you've kind of got a bit of risk mitigation strategy in there in any event. So just a final thing to remember around indexation here. We do have a number of caps. Okay, so we are going to see the general transfer balance cap, personal transfer balance cap, if space exists, and the total superannuation balance linked to that general transfer balance cap impacted from 1 July 2023. Okay, but we are unlikely to see the concessional cap and the NCC cap impacted, but they are subject to indexation. Okay, so this is different to some of these other thresholds that exist within the legislation. Our disregarded small fund assets, $1.6 million, is hardwired into legislation, as is the unused carry forward catch-up threshold, as is the work test exemption threshold as well. Yes, that does still exist. But remember, one of these thresholds is going to disappear from the 1st of July 2023, and that is that $1 million threshold for transfer balance account reporting, because all funds, all self-managed super funds are going to, from the 1st of July 2023, move to a quarterly reporting framework where those events are going to have to be reported 28 days after the end of the quarter in which that event occurs. Okay, so we are seeing one thing, but I think from a policy point of view, we'd like to see a much greater simplification of a lot of these. And in particular, things where we're seeing indexation occur, like the general transfer balance cap pushing up to $1.9 million, yet we have a $300,000 discrepancy within the tax exemption around the disregarded small fund assets. That to me doesn't make any logic whatsoever. So hopefully we could see some policy adjustments to reflect something more palatable and consistent in that approach. Okay, let's now move on to our second one. And this is all about what I see as the interplay between contributions and pensions. So why is this important? What this is now seeing, and this is from the 1st of July 2022, we've now seen those voluntary contributions extended through until age 75 and 28 days after the end of the month in which the individual turns 75. And if you want to get really technical, we could actually, if that falls on a weekend, then you get Monday as well. But anyway, I digress. But what it's now doing is we're going to see a much greater linkage between pensions running and still being able to do contributions. It's going to give us much longer timeframes to make these contributions. So individuals wanting to get money in to super later in life, the fact that we may see inheritances where individuals may not have been able to get them in, they will be able to do so. And whilst they're making these contributions, they may already be drawing down on income streams and or lump sums out of the fund. But this extension of life may be also extended to assets that they've been holding and they haven't wanted to do anything during their working life because of the levels of income that they hold. So, but now through a consolidation process, they're now thinking about, well, do we sell this investment property and use the contribution, make that contribution into super, maybe claim a deduction against it? Do we in-specie share transfers? So we're starting to tax optimize here. And what this is then leading to is we're looking at the immediate commencing of income streams here because we're substituting wages or other income into pension-related income because that now is their primary source for living costs. And this is where things like these multi-pension strategies that we've been talking about really since 2007 when the Howard Costello government introduced these reforms. But it's really highlighting, again, the importance of getting this stuff right. The other thing here is that not only is it about the consolidation of assets into superannuation, but we're also looking at resetting the components that relate to the existing superannuation interests as well. So things like recontribution strategies where we can improve the estate planning outcomes, hugely important and have been for a long period of time. But again, this window now has expanded much, much further, giving us much larger windows to be able to do this type of work, to get these recontributions in. And again, going back to that multi-pension, setting up multiple superannuation interests so you can start to cherry pick where you're going to be taking benefits from within the future, of course, subject to any minimum pension obligations that would arise each year. And the other thing, of course, is just around foreign fund transfers. So things like CUROPs. So again, if we're looking to get some consolidation of superannuation benefits or retirement benefits into Australia, we would have more time ultimately to facilitate that than we would have previously. So here's a little, I guess, diagram here to visually start thinking about things, because what we've got here is this much longer period of time now where we've got an interplay, like I said, between pensions but contributions. Okay, so we can go back to 57, 58, subject to preservation status and the transitional periods at this point in time. And that pension there could be a transition to retirement income stream. It could be that they've met retirement and therefore they're drawing a taxable pension at this point in time until they reach 60 years of age, of course, and then it would be non-assessable, non-exempt income in their hands. At 65, of course, we have that condition of release that has been met, and that would then carry on for the life of that individual, and then naturally any reversionary or death benefit beneficiary tax dependent if they were to receive that as well. But whilst we may be looking at that, this is where this crossover is occurring. because yes, we have typically had non-concessional contributions flowing into the fund, and we've been looking at strategies. If we go back only a few years, we were talking about this window between 60 and 64 years of age to be able to do re-contributions. But what you can see here is that opportunity to do that is now absolutely increased and giving us huge windows to be able to go through and get money in and get money out of the fund, of course, subject to our total superannuation balance. The other thing to note is simply where we have worked back from the 65 previously, then it moved to 67. We are also utilizing that same principle prior to reaching age 75. So we can use that bring forward in that 75th year, but it must be completed before they turn age 75. So again, we can start to work backwards from that point in time and really unpack the way in which those components look, even to the extent that we might have members that are over a transfer balance cap, and we can look at strategies to take money off them and potentially increase the balances of lower balance spouses to get a greater level of equality into those two members. Now, we can also see there, we have, in addition to our NCCs that we can spin the wheels potentially every 3 years, we've got our concessional contributions. So no work test required through to age 67 there. Once we get to that point in time, of course, there would be an obligation to have to meet the work test. So subject to a member's TSB, that is first and foremost. So we may be having to contemplate increases in value at particular points in time and how that may influence what extent we can make non-concessionals, as I just spoke about before. It may require us to dip in a little bit further, a bit more pension or lump sum that was expected to ensure that we can make that re-contribution because it fits into the narrative of the advice that has been provided. These are all things that you'll need to consciously and consistently be active with your self-managed super fund clients. And again, I come back to that multi-pension strategy. We look at withdrawals coming from that original income stream or the interest that has that highest taxable component. We make the benefit payments out, and then we're contributing that money in, and we're establishing separate superannuation interests and ensuring that we don't have any accumulation account, so we can create a 100% tax-free proportion. We apply that against the member's transfer balance account, and then away we go. And as I said before, we can even use this as a strategy to manage the account balances between those two spouses. And we've done some work around that, where even balances in the multi-million dollar benefits with a spouse with a very low balance, you can actually, using this periods of much bigger periods of time, you can get back to something that looks much more equal than I guess had ever been thought of previously, and therefore maximizing the retirement phase tax exemption that would be available. So a couple of things to remember here though. So the deductible contribution rule changes from 67 allows for the work test, or requires that work test to be met, because it has now moved into the Income Tax Assessment Act and has moved out of the SIS regulations. So SIS Reg 704 now no longer requires that work test to be met before the contribution is made. So there is an obligation to have met a work test, but that work test can be made at any stage during the year. So there may be circumstances whereby the contribution could be made, and it could be made earlier, but that work test could be done as late as June in that financial year. So getting these things right and understanding the potential opportunities to find that work, to make sure that it's completed, because one of the big problems that may arise if you get that planning wrong is that there's no real mechanism in this age band now to return contributions. Okay, because if you previously, under the rules, made a contribution and that work test hadn't been met prior to the contribution being made, then the law required you to return that contribution. So that no longer exists, meaning these other contribution types can be caught up in your non-concessional planning. So if you're making that deductible contribution, and for some reason the ATO finds that you hadn't satisfied that work test, then the reality is that contribution is not concessional, but is rather non-concessional. And there is no mechanism to say, well, it's not a concessional contribution, therefore I can take it back out. You can't do that. It is a member personal contribution, voluntary contribution, and therefore may create excess non-concessionals, but also could ruin some of the planning you're doing around the bring forward as well. And that equally applies to the downsizer contributions as well. So the other thing just to remember as we talk about pensions here and matching this off with our contributions is, again, with this recontribution and the multi-pension strategies, if we are looking at drawing down on pensions to be able to achieve some of these strategies, we want to make sure that our instructions around the treatment of these benefit payments is a couple of things. One, prospective, and two, is consistent for the year in which that is occurring. Because what we have ordinarily seen in the past is a standard process. 1, 2, 3 here. 1, we meet our minimum pension, gives us our tax exemption. 2, we would then look to take lump sums out of our accumulation interest. Reason being is that we are going to then improve our ratio of retirement phase income streams to accumulation phase interests, increasing the tax exemption in the fund. And then 3, if we don't have an accumulation account, we are looking to undertake a partial commutation. Reason being, it's giving us a debit against that member's transfer balance cap, which means it gives us more cap space in the future if that individual was to be a beneficiary of an income stream that they want to have that credit applied to their own cap. Now, that, I guess, rule of thumb is still very much in play, but there may be circumstances whereby you might need to look at switching those items 2 and 3 around. So this is all going to be dependent upon the components of the pension and the accumulation account, because you may be providing an instruction in a particular year to be doing that recontribution strategy. And what you have is this recontribution coming in, which leaves an amount in the accumulation interest. You have this order in which the trustees must deal with those benefits. So that second, that inference there is we want to take lump sum second from the accumulation account. You've got an amount that you've just contributed back into the fund as 100% tax-free or as a non-concessional contribution, in essence, and therefore you're required to take the money out of that account because that is the priority of order that you have in place. So what you need to contemplate here is whether to retain tax-free monies in accumulation or alternatively elect to commute from the ABP where it has the higher taxable component. These are all things that need to be contemplated in this process. But what it does mean is there's no hard and fast rule here around which approach you take. You need to contemplate the differences between the ECPI benefit that you're looking to obtain via that amount in accumulation at 2 that we spoke about here before, or you're looking at the commutation requirement at 2 because you want to ensure that you are commuting from that highest taxable component in the first place. So again, there's no hard and fast rule here, but you need to look at the strategies in that particular year to determine which one may be better for you and that point in time. So again, a couple of tips and traps. The timing of notices here is also crucial because where pensions are starting with contributions that have been made, if we don't put in place valid notices, and by valid notices, I am talking about being signed, executed within the right timeframes, again, you'll end up in a position where not only will the notice be invalid, it will therefore deny the deduction and is likely then to also impact the components in which that income stream starts. One thing to remember is we have seen a change to the thresholds for Commonwealth Seniors Health Cards. So 90,000 for individuals, 144,000 for couples. So again, just going back and checking with your clients, do they have this card already? Don't they? Will they actually qualify? It's a very simple message that you could be talking to them about. And I'm sure many of you will have and have spoken to clients who have this And if they ever lost it, pretty fair chance they'll probably lose it at you too. So things like medicines and so forth, hugely valuable to them. Where we're commuting from an existing income stream, again, we spoke about that prospective notion of paperwork and the order of benefits is defined correctly. And again, this concept of recontribution, really, really important here. And we're looking at it in the point of taking from our highest taxable component first and getting the benefit of those multiple interests. I've seen clients that might have 5, 6, 9, 10, 11, 13, I think is the record I've sort of heard. I'm sure there's probably higher than that with multi-pensions because they're proactively looking at the way in which these income streams are being paid and that refreshing of components and making contributions in. There's isolation of those interests away from the pensions or accounts that have the high taxable component that you're looking to erode first and leaving more money for the beneficiaries rather than sending stuff off to the Bank of Canberra. So the other bit into the mix here is obviously adding downsizer contributions. But the question is it beneficial from age 55? So again, what we are seeing here, and this is kind of contribution strategy stacking in essence, is we've seen in the first instance in this financial year, from 1 July 2022, the downsizer contribution age reducing from 65 to 60. What we have now seen from the 1st of January 2023, a commitment by both sides of Parliament in the election mode now become law towards the end of the financial year last year, is that age has now reduced from 60 to 55. So is this a good thing? Well, in reality, it depends. And it's going to depend on the type of client and where they are. Because the positive here is that it maximizes the opportunity for both NCCs and downsizer contributions, giving an individual $630,000, so $1.26 million. If someone is looking to get as much money into superannuation as they can with low balances, fantastic to be able to look at locking those two things in together. It is also going to be beneficial where that member has already breached their transfer balance, their total superannuation balance, so they're above the general transfer balance cap. Okay, so they're ineligible in essence to be able to make non-concessional contributions into super because they are above 1.7 and then or potentially 1.9 from the 1st of July 2023. So they can make a downsizer contribution because the downsizer rules aren't subject to age or aren't subject to a member's TSB. So that is a positive to be able to take advantage of that from 55 years of age. On the flip side though, this is a one-time opportunity to utilize a downsizer contribution. So do you make it now or do you have another crack at it in the future? And what I mean by having another crack at it is if someone is selling and downsizing a family home, 4-bedroom family home at 55 years of age, the reality is that they are probably likely to be buying another principal residence that they are likely to hold for probably another 10 years. Now, yes, legislation could change around this, and I accept that that could be the case. But I refer to this as a last resort contribution. Why a last resort contribution? Because it is a contribution that is not bound by any TSB threshold and is not bound by age, as I touched on before. So you could make that downsizer now, but if they then sell that family home in the future, call it family home 2, or 2.0 is probably the right word, not their second family home, but family home 2.0, if they have now gone above the general transfer balance cap, there is no ability to get any further money into superannuation. So they are limited by virtue of the fact that they've already made a downsizer contribution, they would be eligible to use it again, and they cannot make an NCC because of the fact that they are above the general transfer balance cap. Whereas if we flip that around, and maybe initially they make an NCC in, they still have that downsizer for a future point in time. And that is not going to be subject to any limitations of value or age under the current rules. So the other thing here, and I did touch on this a little bit earlier, This is where, again, the same principles of being caught up. If you make a contribution into the fund, then the risk is if you get any of this wrong, the bandwidth for getting this wrong is much greater than it's ever been. Okay, so let's say for some reason the downside of contribution doesn't meet the qualifying conditions. Okay, so the 10-year main residence exemption or whatever. The reality is that it's now treated as an NCC. Okay, so if the downsize of contribution was made at a time where we were going through an NCC strategy, like the diagram that I showed you before, so if that's in play, this is going to create a potential very big problem. Okay, so either in the context of SS contributions or potentially triggering the bring forward rule when you didn't want it to. Okay, so historically, we have seen downsize of contributions from age 65, could have been an NCC through to age 67, that you can see that there. Now we've got from 55 through to 75 years of age is the window that if we don't meet these conditions, then these issues around being treated as an NCC come into play. Okay, so only recently have we seen that window move from 60 down to 55 because of that age reduction there too. So again, great opportunity to be looking at combining various contribution strategies here and stacking them on top of each other and overlaying that with drawing down of retirement phase income streams and so forth. But there are little bits and pieces in there that we need to be conscious of as well. So this is one of the really big things that we obviously wanted to share with you today. And this is that our SMSF days are back for 2023. We had hugely successful events back face-to-face in July last year. Some 180 people around the country. Getting back face-to-face was a huge boost in confidence for me, I think. So standing in front of screens, for 2.5 years doing these things, there's no better experience than getting in face-to-face, talking, cutting through strategies, looking at case studies, sharing flow charts, diagrams, and other things to help you really get ingrained into many of these topics that we're talking about. So these SMSF Day events will be kicking off on the 16th of March in Melbourne, and will go through until the 5th of April. So 5 capital cities, Melbourne, Adelaide, Perth, Brisbane, and Sydney. We are also going to be providing an online course of the events, and that will be available from the 17th of April. Okay, so we do expect to get, again, very strong numbers this year. To give you some examples, our Perth event and our Melbourne event both initially sold out. We were able to get some extra space in Melbourne. We weren't in Perth. So again, numbers are strictly limited with these, but we are expecting an increase. So therefore, we've added a little bit of extra space to each of these venues, but I encourage you to hang around and I'll share a little bit more as we get through today's session. One of the big changes that is also occurring is the SMSF days have historically, in a face-to-face context, have historically just been me. This year, I'll have a co-host. I can't actually say who that co-host is yet, but they are our soon-to-be appointed SMSF Technical and Education Manager. So we'll have more to share on that in the next couple of weeks. We'll be allowed to announce that formally, but we're going to naturally be looking at the latest technical issues. So things like non-arm's length expenditure, which is hugely important as we work through to the 30th of June this year. We'll be applying case studies, looking in much more detail, these interplays between contributions and pensions and estate planning and the issues and opportunities across each of those. We're also going to look at what to do when things go wrong. So many of our examples, of course, kind of work through this perfect sailing course, and that we get to the end and yes, someone dies. But what happens if there's a dispute, marriage breakdown, many other things, what we're calling when the ship hits the sand, to help you understand and mitigate some of these risks that may go along the way. And of course, one of the things that we do at these SMSF Day events is give you a real practical context and a practical focus. So Best part of this is explaining things through flowcharts and checklists and workbooks, all those things that you tell us are important, that you can utilize not only on the day, but also after the event as well. So I'll have more to share on this, including a special offer for you having attended today that we'll provide at the end of today's session. So let's keep moving. I am conscious of time. So the other one here, naturally, that I see is this concept of ECPI choice. Okay, so we know that there has been some change to this in the 2022 tax return, so from 1 July 2021, but from a strategic sense, we're really only seeing this opportunity present itself now. So what I'm talking about here is where we have periods of both segregation and unsegregated retirement phase periods during an income year that gives us the ability to provide choice or choose which method is going to give us the best outcome. So what we are seeing and what has happened originally or historically is choice just occurs and then you make a decision. Now that this law is in play, this financial year actually allows for choice to be created. Okay, so in my view, choice can occur because of the events that happen, or you potentially can create choice, and therefore it means that the choice is yours. So what you can see on this diagram here, and this is from obviously the introduction of the measures in the first year, is that where you have combinations of retirement phase and accumulation phase, we would have, unless assets were specifically segregated, periods where we'd need to obtain an actuarial certificate. But if we were in retirement phase for that entire period, unless the disregarded small fund asset rules applied, then those periods would be deemed to be segregated, and therefore an actuarial certificate would not be required, but all income gains, losses, and so forth would be exempt from tax. So they would be ignored for the purposes of the SMSF annual return. What this law is allowing us to do is to, in essence, go back to the way in which things worked prior to the 30 June 2017. So here what you can see is under the old, what I call the old laws, is you could get a certificate that covers the entire year. But that is only relevant where you have these periods of deemed segregated or unsegregated periods. Okay, so couple of things here that are important. It is not a formal choice. Okay, so this is done in the tax return, but it is critical that you've actually got record keeping around the choice that is made. So you need some documentation to support the decision. And if you don't make any choice, then the current laws, as you can see there, will actually apply for determining ECPI. So let's just have a look at a quick example here again around this application for choice. So we've got Dean and Karen are members of the DK fund. Dean's retired, drawing an account-based pension for the entire year, 1.08 million. Karen started a TRIS. She then retired. So during the year, her TRIS moved to retirement phase. Dean's then made some NCCs into the fund, which remain in retirement phase to the end of the year. Then they're looking at selling an investment property. Okay. So what is critically important is we understand the tax implications of the period in which that asset is being sold. And what we have here is you can see in here these different periods. So as we spoke about here, we have Karen in a TRIS that moves to the retirement phase. So on the basis that we have this retirement phase period where we've got both accumulation and then pension, and then accumulation and pension again, we have these unsegregated, then deemed segregated, then unsegregated period. If we sell the property there, what we want to try and do, of course, is optimize the level of tax that would be applicable. So the sale at that point in time will result in that capital gain being ignored for income tax purposes, which is the outcome that we would actually want. Now, if that was to be sold after that period, so post, say, 15 April there, the issue then becomes is we're now looking at tax exemption at 76%. So there may be strategies that we could employ here to ensure that when that contribution comes in, we may immediately start a pension at that point in time. So we want to be forward planning here and providing that choice. So creating the choice that gives us the outcome that we want. So what we've got here on the flip side, though, is that if we sold at that point in time, will we necessarily want to have that loss lost forever? And it's really important here to understand the difference and why applying choice here would be advantageous. Because we have a sale here in that deemed segregated period that would create the capital loss, that loss is lost forever, as I said. But because we would look to apply choice and get a certificate that covers the entire financial year, what we're looking at doing now is we're actually applying the statutory method for CGT under section 1025 that would allow for us to actually carry forward that loss. And you're going, Aaron, well, why would that actually be that relevant here? Well, it becomes relevant in respect to the survivor of Karen and Dean, because they are, in essence, if we go back, are going to potentially here have an excess transfer balance issue. On the basis that they have an excess transfer balance cap issue, it will mean that unless they take money out of the fund, they are going to have both retirement phase and accumulation phase assets. So if they are selling assets at a future point in time, that is going to allow them to apply those capital losses to any capital gains in the future. So that strategy does become critically important if you can foresee that where one member may reside in the fund subject to the death of a primary beneficiary, and that creates an excess transfer balance amount, then that capital loss is going to be hugely important in the future, in particular where you have lumpy assets that may be sitting on significant capital gains. So from a record keeping point of view, again, this is something that you would want to be documenting. You're looking at the evidence here. You're looking at the fact that it doesn't meet this disregarded small fund asset rules, that there was periods of both retirement phase and non-retirement phase, that there is a claim that's being done, and therefore you're making that decision to provide choice. So again, if you don't do anything, you fall into the default model, and that is end of story. But if you do, then documenting these decisions is critically important. And this is just one of 70, 80 plus documents that we have on our Smarter SMSF platform now that you can go in and access and utilize our integrations with Class, BGL, and shortly Supermate as well. And the last one here I just want to touch on is this whole concept of certainty post Hill and Zuda. Many of you, unless you're living under a rock in the SMSF space last year, will know that the Hill and Zuda High Court decision was a critical decision for the SMSF sector. It didn't provide any clear change in the decision-making that we'd seen through a number of various state decisions. If we look at cases in WA, Queensland, so Cantor Management in South Australia, Iopolo and so forth. But what it does give us is a Commonwealth decision that confirms many of the decisions that we saw in various state-based jurisdictions. And what that does tell us with absolute certainty, and is consistent with the views that the Commissioner expressed back in, I think it's, got to get it right, I think it's 2008/3. Someone can tell me if I'm wrong and you can put it into the chat area. But the SIS regulation, so 59(1)A of the SIS Act and SIS Reg 617A has no application to SMSFs. And what that means is that when we are looking at the payment of death benefits, and we're looking at a death benefit nomination, and in particular binding death benefit nomination, we're not looking to the law, the legislation within the SIS Act and SIS Regs, but rather we are looking to the governing rules. What does the trust deed say? And what must we do to ensure that we have created a valid binding death benefit nomination? And that's the critical bit here, and what has been tested over time in those various state jurisdictions, and therefore the decision in Hill and Zuda. So in the following conditions of the, so in the conditions of the deed here, it is crucial that you understand what the governing rules say in order to comply with its requirements. Okay, and this is the real important bit here, because SMSFs don't have to follow the prescribed form of a BDBN, and therefore we have this concept of non-lapsing. What we do find, and this is something that if you haven't done already, you should be looking at, quite often we see deeds that have been set up that actually import the requirements of SIS Reg 617A. So even though the rules don't apply, the construct of the clause or rules within that fund's deed, in essence, bring that into the way in which the trustees must operate, and therefore the member would generate and need to comply with their death benefit instructions. And this was the case in Donovan and Donovan that you can see on the right-hand side here, that talked about the nomination had to follow the statutory requirements. And those statutory requirements, of course, were referring to the requirements set out within the superannuation laws to qualify for concessional tax treatment. The judge then ultimately said it is quite clear here and plain that the intent of the deed is to require that nomination to be in the form described in Regulation 617A, subsection 6. Okay, so you are looking to the deed. You need to ensure that what is set out is in essence black and white. Okay, so you need to understand what above and beyond the completion of that form is required. So does it require approval or acceptance? Does it require receipt of acknowledgement, which we saw in Cantor management case about being served? These are all things that are imposed by a deed, but don't necessarily need to be there. Okay, so again, covering these things off, making sure you've got the estate planning piece, this death benefit piece in order for your clients will be critically important as we see now the dust really settle in this space, and allowing for us with absolute certainty and clarity that the High Court decision, without matter of fact, says that we follow what the deed says. So we need to ensure that our deed does what we want it to do. Go back to your deed provider if you want to find out more around that impact, but in essence, make sure that you've got that right. Understand the impact in the context of your client death benefit nominations, as I said. Think about, as you're working through this process, how much flexibility and certainty is required with different clients, subject to the SMSF client situation. Blended families is a really good example where greater certainty may be required versus a husband and wife, happily married, and money basically passing through to the estate thereafter. Again, is there much certainty or much more structure that need to be put in that circumstance versus someone that may have been married second time, third time, fourth time, fifth time, and so forth? Contemplate the reversionary status of income streams or income streams generally, and then whether the reversionary is appropriate. They won't always will be. So check that your documents in respect to the payment of income streams actually match the estate planning work that is there, that the outcomes that they're intending to have actually will transpire. And again, we see examples where reversionaries may be in play and they're forcing money to go a particular way when that is clearly not what the instructions of the individual is wanting to achieve through their will and other testamentary documents. Again, understand the broader succession issues and considerations in the fund in respect to incapacity, death of individuals, and so forth. And in some situations, it may be prudent to consider a guardian to help oversee the operation of the fund. And finally, make sure you are regularly reviewing it. Okay, you cannot set and forget this stuff. You need to be on your clients on an ongoing basis because these things are critically important and the things that most likely end up in court, given the volume of wealth that sits inside superannuation and self-managed super funds. All right, so a little bit about our SMSF day here. So you have turned up today. So first of all, I say a big thank you. So we've had huge numbers obviously registered for our session. We have got now available our early bird prices. These are available until the 19th of February. However, until the end of this week, we are giving you a further 10% off. So you can see there the webinar offer in respect to the face-to-face event and the online course. If you want to go to a face-to-face event, but you want access to the online course, you can pay an extra $110 and you will get the course once that is ready as well. To do so, you need to apply the coupon code SUPEREARLY2023 at the cart to get the further 10% off. So again, it is only available until Friday. then it will go back to that early bird price. For our Smarter SMSF members, documents and training, the prices in the webinar offer are available to you throughout the ticket sale period, generally, subject to capacity, of course. You will be sent a separate member email that gives you that coupon code that you can then apply to the face-to-face events or online course, but you can apply this week, that super early 2023 as well. And that is the price that you get as a member for the duration until these events are up and about. So a few questions, the agenda, who's it for, what's included in my ticket, CPD, all these things we actually have up on our SMSF Day website. So what I will quickly do is I'm going to jump across to the page. So it is now up on our site. You can go to the CPD training SMSF Day 2023. So we have now put up here all the information in respect to the day. We've got details on the agenda. We have information about being able to buy the tickets here, which you can now do as well. You simply need to click on the buy now. It will take you to the product. You can add the number of tickets you want in your cart. You'll be able to then apply the coupon code. It will discount that ticket down from the early bird price, and then you'll receive your confirmation about that. If you are buying it for multiple people, you will need to put the names in of those people. If you are buying it for another individual, we will be asking, obviously, in that process, and we'll be issuing the ticket for the event to the individual that is attending. Okay, so there's a number of other things that you can find on there, the FAQs that we spoke about. And if you've got any questions, you can submit a ticket to us or question, or simply just give us a call, and we'd be more than happy to go through and answer any questions that you may have. So the final couple of things here as one last bonus to get you thinking about whether you want to come or not. Any ticket purchased today, not only do you get the benefit of our super early bird, you'll also go into the draw to win one of our CBD regular memberships. Buy 2 tickets, you get 2 chances. Anyone that buys it over the next couple of days, you'll go into the draw to win one of our CBD quarterly subscriptions. And again, those same principles apply based upon the number of tickets. So some key takeaways as we wrap up. I am conscious we've just gone over time, but hopefully today has given you a huge amount of value around some strategies that you can be looking to employ with your clients. So it's about giving you the range of opportunities, okay? Contributions, pensions, estate planning, there's a huge amount of work that can be done. Our SMSF Day, of course, gives us an opportunity to deep dive into many of these topics. I encourage you, if you've been before, our feedback has always been amazing. I think last year we scored 4.89 out of 5 or whatever it was. And if you speak to anyone that's been before, they'll attest to the value that you get from the day. Now, not only, I guess, with our training and the way in which we spoke about these strategies, we do play a pretty pivotal role with our members to being able to support them right throughout the year, whether it's with training, whether it's with documents, all these different products that we have across our education and document solutions to support your business. Like I said before, we're going to ramp up that capacity to support you in that education component as well, with an announcement in the next couple of weeks too, that I'm really looking forward to, and it's going to be a huge boost to the way in which we support our members this year. So one final thing, I guess a follow-up for you to understand what's next. So a copy of today's slides will be sent in an email to you within the next hour, okay? It'll include the slides and a survey link. The survey will pop up after you leave today, so if you don't get a chance to complete it now, we'll send it in the link. We are recording today's session. It will be available on the website within the next 48 hours or so. You'll also receive a CPD certificate for attending today live only. So we will send that to you as well within the next 48 hours. If you haven't previously opted in, you will need to just make sure you've got that address confirmation. So if for some reason you don't get a CPD certificate in that next 48 hours, first of all, check some junk folders and so forth. If not, give us a call. You can speak to David here, our sales and account manager, and he will just make sure that you have confirmed that email address, and then we can reissue that to you through email as well. So that's it. Thank you, everyone, for joining me today. Like I said before, hopefully you got a huge amount of value out of today's session. You can see there a number of sessions that we have coming up. If you want to find out more about our SMSF Foundations course, we have a webinar coming up shortly that you can register for as part of our demo suite of sessions that we run. Our next CPD webinar is around the latest intel on LRBAs. We have the SMSF Association National Conference in Melbourne coming up in about a month, or just under 3 weeks' time. Actually, I was going to say a month's time, 3 weeks' time. And then finally, we've been doing a lot of work around additional documentation with dealing with trustee changes. And again, that webinar, our product demo with some of the documents that we've created in that space towards the end of next month. I will hang around now, answer any questions that are there, but for those of you that can't hang around and have attended today, I do say a very special thank you. I hope you found today hugely valuable, giving you a lot of insight, a lot of ideas, and I hope to see you at an upcoming event by Smarter SMSF in the not too distant future. Take care and bye for now.